gold keeps roaring to record highs, begging the question, what is behind this massive bull in bullion? Now, most people say it's inflation because that's just what everyone says. A few others might point to interest rates or deflation, but the real answer is none of the above. Think about the last two major gold bulls. There's the current one, and before it, the 1970s. That previous run was during the Great Inflation, so that seems to correspond with conventional wisdom of gold as the ultimate inflation hedge. But then what about the current gold boom? It began back around 2005 and has been going higher throughout one of the least inflationary periods in generations. Even the past few years when the supply shock boosted consumer prices, gold struggled. While prices were rising, it only got going late in 2022 when consumer price rates were retreating. Yeah, you heard me right. Gold floundered pretty badly during the worst parts of what everyone called inflation in 2021 and the first 3 quarters of 2022. Then there was that prolonged period in between the 70s and today when gold did nothing. Its price languished for decades. And some have speculated that was because of central banks controlling the price, but as we'll see, that was just another instance of giving officials far more credit than they ever deserve. So, why did gold outperform during the inflationary 70s, then wildly underperform the 80s, 90s, and the first half of the aughts, only to do even better during the thoroughly disinflationary 2010s, right on into now the 2020s, when consumer price rates are receding the most? There is something else going on here, behind the scenes, under the surface, inside the black hole. This isn't really about inflation or deflation. This is another one of those very serious, big-time, long-run matters, and it touches pretty much everything. So just to establish where we are with gold, and to really put to rest this conventional wisdom, let's look back, starting with where we were in 2020 and 2021. Consumer price rates were about to explode in 2021, and you would have thought gold prices were going to go higher with them. Now, gold did go up pretty sharply. In fact, it got above $2,000 per ounce for the first time in the middle of 2020. There's your first clue. During the worst of the pandemic, when everything seemed to be falling apart. So it gets above $2,000 in August of 2020, and then it drops, going all the way back to $1,700 per ounce by March of 2021. Then it was mostly sideways from there, even as consumer price rates began to absolutely soar. So while what everybody called inflation was at its highest, gold wasn't doing much of anything. Now, it did jump early in 2022, got back above 2,000 in March of 2022 with the Russian invasion of Ukraine, but almost as soon as it did, it immediately crashed all the way back to $1,600, right when consumer price rates were at their highest. So right when you would have thought that gold needed to be there the most, it went in the opposite direction. But then, in October of 2022, all of a sudden, gold began to skyrocket again, in a way that it should have during 2021 if it was really about inflation and skyrocketing consumer prices. So quite obviously, there is something else going on here. It's not really about inflation, consumer prices, or anything of the like. The fact that gold was surging during the first half of 2020 offers us a clue. It has to do with uncertainty, but uncertainty about what? This is something that we often contemplate and talk about, and I wrote about this in our deep dive analysis, and there's a lot more to this story, including another half which is about why stocks aren't money and haven't been since the 1930s. And that's what Eurodollar University is really here for, to move beyond the myths and misconceptions of modern conventional wisdom that's supplied by economics with its own agenda. And right now we're at the end of our fall sale, which means our best prices on all our products that help you get to the bottom of what's going on right now. There's the daily deep dive analysis, which goes way beyond what we cover here on YouTube, the daily briefing to keep you caught up on everything that's important and what's happening, and Eurodollar University memberships that give you the necessary and badly needed background behind all of this, and all the information about the sale, the subscriptions, the memberships. It's at our website, eurodollar.university. So we need to go all the way back to the Great Inflation to really start figuring out what's happening with gold. In fact, really before the Great Inflation to the late 1950s and early 1960s, when, contrary to popular perception, the Bretton Woods system was already breaking down. In fact, with the formation of the London Gold Pool in November of 1961, that basically ended Bretton Woods as the Eurodollar era was beginning. Now, we've got to remember that back in during the Bretton Woods system, governments were obligated to redeem gold at $35 an ounce, but there was a private marketplace for it too. And central banks could convert their dollar balances at $35 to the US government, then sell the gold they got from the US government in the private market at a higher price. So when gold's price was going higher in the private market, that would lead to foreign central banks and governments draining US reserves, which is really what Robert Triffin was talking about. And we'll talk about that in just a second. So the free market price of gold would rise because the demand for money was rising, and that demand for money was being met by a couple different things, including, most importantly, as I said, the rise of the Eurodollar. So as Robert Triffin had warned, that drained U.S. gold reserves, which undermined the Bretton Woods system, kicking off a period of monetary instability that kept on going right through the 60s and 70s. In trying to deal with that instability and trying to deal with the draining U.S. gold reserves, in November 1961, the United States and seven other European countries got together to create what's called the London Gold Pool. They pooled their reserves, their gold reserves, to try to limit the impact of this drain on gold reserves on just the one country, the United States. And they promised about 240 tons of gold, half of which was supplied by the United States, Germany, the UK, France, Switzerland, and a couple others. What Robert Triffin really said was that you can't have a national currency backed by national gold reserves try to fill the role of an international currency, because eventually the demand for currency would be such that some way it would be met, that's the Eurodollar, and that would lead to a drain on gold reserves. It would always be this flaw in the design which would lead to its inevitable failure, which is what we're getting to in the late 50s and early 60s. And it was the Eurodollar that continued to supply more and more dollars outside the United States as the international currency, and this tension with the Bretton Woods framework and the national gold reserves was simply the Eurodollar beginning to take over and really taking over the roles of an international and global reserve currency. By the time you get to 1967, the London Gold Pool fails. France withdrew in late 67, and they started redeeming their dollars for U.S. gold too. Then in March 68, the U.S. asked the U.K. to close the London gold market for a holiday just to try to halt the withdrawals, and that gold would no longer be redeemable at $35 per ounce, except by a couple of official entities which were not active in the private market. So essentially from early 68, March 68, we had a two-tiered gold price system where officially gold was redeemed at $35, but most of it was taking place at a higher gold price as gold was continuing to go higher in price. And then finally, Germany left Bretton Woods in May of 1971. Of course, the U.S. famously suspended gold convertibility in August of 71, which really wasn't the biggest issue for Nixon administration at that time. And what we also should point out here is that as gold prices were rising unofficially as well as officially after 1971, throughout the 50s and 60s, interest rates were rising too. So as gold surged into the 70s, the great inflation, interest rates also soared. That's not the correspondence either. The entire thing was the messiness of the breakdown of the Bretton Woods system, and then the attendant inflation that came with it. Not because the Fed printed money. The Fed didn't print any money here, but because the rise of the Eurodollar system was leading to all of this volatility. There were serious questions about whether this Eurodollar way of doing things was indeed actually viable. That's what drove gold higher, was the breakdown in the Bretton Woods paradigm and the uncertainty surrounding the Eurodollar's ability to meet that Bretton Woods breakdown, to fill the roles of reserve currency, and do so in a way that would lead to a stable and sustainable future. That's what drove gold higher. Not inflation necessarily, but that paradigm shift and the necessary uncertainty that's surrounding it. As Robert Solomon said at Bretton Woods, by the way, in 1984, in a conference that was sponsored by the Federal Reserve Bank of Boston, he said regarding international liquidity, the Bretton Woods Agreement made no provision for the regular increase in reserves required by a growing world economy. Whether the designers of the agreement anticipated the dollar would play a major role as a source of reserve growth, I do not know, but that is what happened. And what he's really talking about is the Eurodollar. So gold goes higher as questions during the great inflation, the uncertainty, the volatility, the messiness of the great inflation. So the messiness of the Eurodollar handoff and take over the global reserve system. That's why gold went higher. And that also answers why gold stopped going higher in the early 1980s. All of those questions that were raised during the 1970s and great inflation began to be answered in the affirmative during the 1980s. The Eurodollar was indeed able to take over the roles of a reserve currency and do it in a way that led to stable economic and financial growth. It benefited the entire world. It unleashed a period of unparalleled prosperity in human history. So during that situation where the economy around the world is booming, prosperity is flourishing, there's no need for the hedge that's provided by gold. There's no need. The interest in gold simply fell off. So gold that was above $700 per ounce still in September 1980, it fell to around $300 pretty quickly, moved back to $500 in 1987, but basically downward throughout the entire 1990s, getting to around $250 per ounce in 2001, because nobody cared about gold. With that level of prosperity and that widespread flourishing of economic growth around the world, globalization, cooperation, and everything else, it's a period where you don't need an uncertainty hedge because things got to be, at least they seem to, pretty certain. There's this claim that central banks had been manipulating the price of gold to hide inflation. Greenspan appeared before the Committee on Banking and Financial Services in 1998. And what he said was that, quote, central banks stand ready to lease gold in increasing quantities should the price rise, which many people have taken this to as an admission that Greenspan was saying, we don't let the price of gold rise. But what he was actually talking about was that if someone were to manipulate the gold price outside of the central bank or outside of anyone, if some private market participant was trying to manipulate the price of gold and get it to go higher to corner the market, like the Hunt brothers had in silver the decade before, the central bank, the Federal Reserve, stood ready to lease gold, which then would be sold on the market, and therefore undermine this attempt to corner the gold market. Is what he was saying is we're not the ones manipulating gold. He didn't admit that they were manipulating gold. Nobody wanted to own gold in the 1990s or the 1980s or the early 2000s because everything seemed to work really well. But entering the 21st century, people started to get the sense that maybe this Eurodollar way of doing things was going a little bit too far. So you see gold prices begin to trickle higher from 2001 through 2002 and 2003, the dot-com bust, not really inflationary, but it really gets going in the middle of 2005. Just as the symptoms and signs of Eurodollar overdoing it were becoming so loud and clear, only a central banker could have missed them. Everybody knew that there was a housing bubble in the U.S., everybody outside of Ben Bernanke and Janet Yellen. So they could see that the Eurodollar, which had provided resources and recirculated money and credit throughout the economy, the global system for decades up to that point, and done a really good job in encouraging and supporting prosperity that was starting to go off the rails. So in the middle of 2005, the signs were becoming alarming. And then, of course, we had the 2008 crisis, which simply confirmed that the Eurodollar was at the end of its useful life. The problem is, on the other side of 2008, the Eurodollar remained in place because, unlike in the 1960s and 1950s and 60s and on into the 70s, there was no legitimate and useful and usable replacement rate available like there had been when Bretton Woods breaking down. As Bretton Woods broke down, the Eurodollar just took over under the surface, while nobody was really paying attention, benign neglect from authorities. In 2008, it caught too many people off guard, even though the signs were everywhere beforehand, and there was no competing successor arrangement ready to go afterwards. And that's really why people have been talking about it ever since then. So while gold was volatile during the 2008 crisis itself, because of a couple reasons, including the use of gold as, first of all, a collateral of last resort, especially the leasing episodes that came up in 2010 and 2011 with the BIS. I could do a whole video on that. But it was also used for just emergency liquidations. If you have unallocated customer gold and you have a dollar shortage, that unallocated gold becomes a useful asset that the bank can use for its own dollar purposes. And you did have a sharp drop in the gold price between 2011 and 2015, which may be because gold overshot to the upside in the aftermath of 2008. That's part of it. There was some optimism that maybe after the initial crisis in the early aftermath period, where it didn't look like everything was going to recover, by 2013 it seemed like, okay, maybe we don't need to replace the Eurodollar. Maybe just by pure chance, authorities had hit upon the right number of QEs. And so 2013 You got a little bit of an optimism. I mean, the 30-year swap spread, for example, turned positive in the middle of 2013 as gold prices were going lower. So there was sort of a little mini burst of optimism and revival that the system maybe wouldn't need to be replaced, but that didn't last very long. There was simply no way to go back to the old way, to the old Eurodollar way. And while we were stuck with the Eurodollar as it is, it simply meant that rising uncertainty, like in the 1970s, there is no viable alternative. Questions about the paradigm shift only get louder and louder. So demand for that hedge goes up and up and up. So why did gold disappoint during 21 and 22? Well, for that period, it looked like the economy, the world was actually going to recover, that maybe there was a red hot recovery, that the pandemic had forced governments around the world to finally address all the shortcomings that were left over from 2008. And you could say that the market was ready for rates to go up, but that really amounts to the same thing. For a couple years there, it looked like maybe the 2010s had been left behind and the 2020s would be something more like the 1990s, for example. But that didn't last very long, and that's why gold started rising in October 2022. Not only was that when markets started to break with central bank rate hikes, you saw inversion in the yield curve, massive inversions, crazy inversions all over the world. You got recessions in Europe and elsewhere. You got disinflation that started to grow. More and more of these signs that we were not escaping the 2010s, that we're going to go back toward the 2010s, which meant in terms of gold and this paradigm shift and the hedge against paradigm shift, the same high level and even higher levels of uncertainty about the entire global order. If the world had been successful in their pandemic relief efforts in 21, gold prices would have continued to languish. It would have been more like the 1990s in that respect, not just gold prices, but also the general economy. But instead, in October 2022, amidst collateral shortages, monetary disruptions, economic recessions, and everything else, gold then began to soar because people realized the Eurodollar problem, the globalization problem, hadn't actually been solved. In fact, they may have gotten worse. It's not about inflation or deflation, as I said. It's about this paradigm shift and the uncertainty surrounding it. That was the case for Bretton Woods as it broke down in the 50s and 60s, even before we got to the Great Inflation. And then the Great Inflation just reinforced all the concerns that were rising about whether or not the Eurodollar paradigm might actually work. But when the Eurodollar hit its stride in the 80s, the demand for gold plunged, and it stayed that way, languishing for decades, only to be revived in the early 2000s and really the middle 2000s, right when the system began to show signs of getting toward its last legs. And gold has been higher ever since, not in a straight line, because the Eurodollar needs to be replaced. It's not being replaced, and we have no idea when something might start to do it or what that something could even look like. And the further we go down this same road, and the more it looks like we're stuck on this road, the greater the uncertainty in all of those, the higher gold will go. Keep pointing out it's not really about recession in the US, it's really the long run, including what interest rates are saying about this long run potential, and that's what we got at the video link below. As always, I thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. Check out our fall sale, final days there. And until next time, take care.